Hey guys, welcome to this week's Q&A, and this is where I talk about 5 of the top comments or questions that I found on my YouTube channel in the last week. So let's go ahead and get started. So a lot of these comments are based around the report that was just released by the New York Fed pertaining to household debt and credit. And we have reached all new highs in America as far as debt. And so let's go ahead and dive in and let's talk about how this will affect housing, home prices, and really affordability. Can buyers even afford the houses? We know the answer to that, but let's get started. So let's go to the first comment here. Folks, the millennials will need to allocate an additional 10 to 15% of their disposable income to student loans again shortly. This will be the trigger for massive drop in qualified buys. I think they meant qualified buyers of homes and auto loans. Supplies for both will balloon, and then it's night-night for the economy. All right, so let's talk about this. If you have a federal student loan, which most of the student loans are, basically from 2020 until now, you have not had to make any payments, and interest hasn't even accrued in that time period. But guess what? As of September 1, your interest payments will start accruing again on your debt. And by October 1, you need to start making those loans again. And I get it. A lot of people have student loans and they've kind of forgotten about them. And they were hoping that the Biden administration would be successful in wiping these loans away. And some of the states actually have this student loan forgiveness if you make a certain amount of money within a certain bracket of income, and let's say you buy a house, or let's say you're a teacher or an educator. They've got a lot of these different programs out there to wipe out a lot of the debt. But what I get so upset about here is, why are we bailing people out? Always bailing people out. Guys, I'm not for bailouts. I think if you signed up for student loans, you should be paying your debt. But what I want to do is dive in and say, what's the big deal? Why are we talking about this? Why is student debt so high on the agenda? Now, before we dive into the charts, I just want to say that congratulations, America. We just exceeded $17 trillion in consumer debt. But of student loans, it only makes up 9% of our debt. But guys, guess what? You need a job. You want a good job. You want to go to college. That comes with it. Let's take a look at these charts from a study that was done in 2017. So if we're talking about bailing students out, first of all, let's see, of this 9% of the $17 trillion in debt, how do they judge defaults and who's defaulting in the first place? So in this chart, you'll see the 3 lines at the top of the graph where we see the most student default is somewhere around the age of 33. And at the top of the list, students that have private for-profit 2-year college debt default the most. That's followed by private for-profit 4-year programs, and then the public 2-year program. So that's represented right here. So these students that are dropping out, why are they in college? What are they going for? So at the top of the list here, you see they are associate non-graduate studies. Then comes your bachelor's or higher, but still non-graduate studies, then followed by associate graduate studies, and then bachelor or higher graduate studies. So then I ask, what are they studying, these students that are in default? And first at the top of the list are arts and humanities, then followed up by business, vocational, and then your STEM programs. And then finally, we'll take a look at the student loan default rates by family background. And it appears that most people that are defaulting on their college debt are really from a family background where they have below mean income. So in conclusion here, talking about student debt, it's kind of hard to put your finger on exactly why students default. But this article says that the stark differences in default rates really shows that there are conditional correlations. However, the most default seems to be from those who were attending a 4-year private for-profit college, and that dropping out is the second strongest predictor of default. Guys, you can put two and two together here. I mean, if you're a student that's going to school, you sign up for the debt and then you drop out, chances are you probably aren't getting the type of job that you would hope for to pay down this debt. So yeah, I think that, for a lot of these first-time buyers that are trying to buy a house, I mean, this college debt, now that we know it's not just going to be erased by the administration, you will need to start considering these payments in with your debt to income ratio, and it certainly will affect the amount of home that you can afford if you can qualify at all with today's home prices and mortgage rates. So here you have it. What can I say? And, but the mainstream media continues to say that the economy is so strong and that we're doing so well in our job market and that unemployment is super low with great paying jobs. So paying back your student loans shouldn't be a problem in the first place. Now, our next commenter says that the housing market is very scary and unstable, and I hear people are losing their homes because their home insurance was canceled, a trend in Florida and California. Well, guys, I have to tell you that homeowner insurance is not required by law. However, if you have a mortgage on your home, your lender will require you to have insurance until you pay off your debt. But even if you don't have a mortgage on your home, it's a pretty darn good idea to protect your home with the right policy. But let's talk about those that are being affected by this insurance situation. When you buy a home and you need a mortgage to do so, you get qualified for a monthly payment that includes your homeowner insurance policy. So let's say when you first buy your home, your insurance premium is $2,400 per year. That's $200 a month, right? So, but what happens if your insurance company cancels you or refuses to write you in the next year's policy? Well, a few things could happen. You could be required to get insurance from a company that charges you, let's say, double the amount of your original canceled policy. Maybe your new company wants $5,000 a year to cover your property. Now, instead of $200 a month, your expenses for your homeowner's insurance has just gone to about $416 a month. Guys, that's more than double. Now, if you can't get a policy, you may send your mortgage into default as it's a violation of your lender's requirements. And in this case, you could be forced to sell your home or get foreclosed on. Now, this commenter mentioned policies getting canceled in Florida and California, but let's take a look at exactly what's going on with homeowner insurance cancellations. So in June of this year, according to a Louisiana publication called the Daily Advertiser, 1 in 5 Louisiana homeowners policyholders saw their policy canceled, survey says. It goes on to say that nearly a fifth of homeowners insurance policyholders surveyed in Louisiana said that their provider canceled their policy. And as we scroll down through here, it says Louisiana's property insurance landscape was thrown into crisis after facing several devastating hurricanes in 2020 and 2021. Hurricanes Laura and Ida alone combined for 800,000 Louisiana insurance claims, totaling $22 billion. Now, what about all the people that have bought homes in the last couple of years and are in this area where there were 800,000 claims? Well, according to this article, 1 in 5 are getting their policies canceled. Now, you might say, well, that's happening in areas of bad weather, and that is true. But here in this article, a homeowner's policy was canceled by his insurance company because the insurance provider said they flew a drone over top of his house and felt that he was a high risk to insure. Now, according to the article, I'll drop the links below. This man's story goes on to say that when push came to shove, they said, well, we didn't actually fly a drone over your house. We used the aerial photos on Google and discovered that you had clutter in your backyard, of which happened to be some tires that he used in different times of the year to change the tires on his car. They were neatly stacked up against a fence line, but that was one of the things that they said it was too risky for them, and they basically dropped his policy. And this man lives in Oakley, East Bay, California. Now, here we are at The Nugget, a publication that was published in May of this year. And this is talking about Sisters, Oregon, facing double-digit premium increases or the inability to get renewed. Many property owners in Sisters County are scrambling to lower their cost or obtain new coverage. Some report being canceled as a risk of wildfire is causing insurance carriers to reassess their exposure. Now, for a lot of homeowners that are in areas that are risky for forest fires, many of them are spending a lot of money on their houses. They're actually changing the siding and their roof materials so that it will withstand fire. And to these insurance companies, a lot of them are just saying that's still not good enough. In fact, the Senate Bill 82 here in Oregon would restrict how insurance companies can use wildfire risk maps. But as the prices of homes have increased dramatically in Sisters, with over 100 properties in Sisters country selling for more than $1 million in 2022, some insurance companies are reaching their portfolio maximum. And here we are on CBS Colorado, where they say that Colorado homeowners, including Marshall fire survivors, see insurance premiums climb and policies canceled. And this article goes on to say that Colorado's affordable housing crisis is at a tipping point. On top of soaring property taxes, insurance premiums have now doubled or even tripled for some homeowners. Others are seeing policies canceled altogether. So now let's check out the online publication from Guardian as it pertains to Florida. And this was dated July 15th. Florida rocked by homeowner insurance coverage. I may have to sell up and move. Says soaring hurricane coverage premiums are bad news for the state's homeowners. And this article says that Ron DeSantis is accused of dragging his feet. Now, when we're talking about Florida, we're talking about the third most populous state in the U.S. And they've been grappling for some time with a property insurance crisis that is making home ownership unaffordable for many. And then finally, guys, we'll look at this NBC article where it says that homeowners in California and Florida are running out of options to protect their homes. Now, guys, the big thing here is, we're buying payments as homeowners, right? So as we're looking at debt mounting up in the country, we're looking at, home prices being higher than they've ever been. And now home buyers didn't even think about what would happen if their policies are canceled or that their homeowner policies double or even triple. For most Americans that are buying at the top of their income to debt ratio, this extra $300, $400, or $500 a month, if they can get insurance coverage at all, can basically throw them over the edge as far as whether they can afford their mortgage payment. All right, moving along, let's talk about debt, because with this new, Fed financial release on the 8th, I had a comment that came in from actually somebody who has a lot of credibility as far as I'm concerned on our channel, a lot of good comments. And certainly nothing to just, turn your nose to. But Lawyer 1165 said, why do folks on YouTube focus so much on credit card debt? They criticize the mainstream media for the inability to cover financial issues properly, but they never look in the mirror. Here's another analysis of credit card debt, and they're referring to this Wolf Street article. The commenter goes on to say, I hope you won't cancel my comment. Now, instead of canceling your comment, I want to talk about it. So in order to do so, let's go ahead and take a look at the article they're talking about. Here on wolfstreet.com, it says, are drunken sailors still not in trouble with their credit cards? Keeping an eye on them because someday enough of them will get into trouble to move the needle, but not yet. And the main thing that this article says is that most of the balances, they're talking about credit card debt. And by the way, guys, we exceeded $1 trillion in the second quarter of this year of credit card debt in America for the first time ever. But this article says that most of these balances get paid off the next month and never accrue interest. Only a small portion gets stuck as interest-bearing debt. But the data doesn't spit out interest accruing credit card balances from balances that are paid off in full on the due date and never accrue interest. So let's dive in. Here in an article on Yahoo Finance, it says that U.S. credit card debt reaches an all-time high, exceeds, just like I said earlier, $1 trillion. Now, guys, we have a lot of data that's available on this credit card debt, and a lot of it can come from like TransUnion, Experian, Equifax, the credit reporting agencies. This Yahoo Finance article summarizes some key takeaways. And by the way, it was published on August 9th. It says that U.S. credit card debt increased by $45 billion from Q1 of 23 to Q2, leading to an all-time new high. And it also says that nearly 50% of cardholders carry debt from month to month, which, by the way, is up from 39% in 2021. Now, it does say that the rising figure shows a strong consumer economy and lower reliance on cash. The article goes on to say that balances are up 34% from pandemic low of $770 billion in Q1 of 2021, says Ted Rossman, senior industry analyst at Bankrate. And he says even more troubling is the fact that 60% of Americans with credit card debt have had it for at least a year, up 10 percentage points from 2 years ago. And if we look at a reporting from last year, balances were carried month to month on credit cards as well. And in this lendingtree.com article, according to the American Bankers Association, of all active credit card accounts in the third quarter of 2022, 56% carried a balance at some point. And it also goes on to say in this article that unfortunately, most people with an active credit card account don't always pay their bills in full. A November 2022 LendingTree survey found that just 35% of cardholders say they always pay their credit card balance in full every month, while 65% say that they carry a balance at least some of the time, and nearly half, 46% of those cardholders who have card debt say it will take them at least a year to pay it off. The problem that goes along with consumers not being able to pay off their credit card every single month is that interest rates have climbed drastically since the third quarter of 2022, and so has credit card debt. So as we all know, especially the ones that can't afford to pay off their credit card, the problem here, guys, is that with credit card debt being higher than it's ever been before, and so many Americans not being able to avoid the interest payment by paying it off in full, is that interest rates have really gone up a lot through the last 2 years. And this article continues to say that for cards accruing interest, the average in the second quarter of 2023, the average interest rate these credit card companies are charging is 22.16%. Now, it doesn't take a rocket scientist to figure out, guys, that if you're paying the minimum balance or not paying off these cards, the amount you're actually paying for some of life's necessities, because let's face it, we're putting fuel and groceries and home repairs and things like that on these high interest rate credit cards, is that for many, they just will never be able to pay off this debt. And before we move on to the next comment, let's just take a look at this Fred chart that shows the current state of credit card interest rates. Look what happened here in February of 22 when the average rates were 14.56%. The dotted line all of a sudden separated big time. You can see the dots, and it just went almost straight up to where we are today. And as you can see here in May of 23, it was a little lower than where it is today, but still at 20.68%. So our next commenter says that the Federal Reserve is owned by private banks, committee voters, and elected by private banks. And I think that what this commenter is saying is that they don't know why this FOMC or, the Federal Reserve Committee, has such power based on who they're voted in by or elected by to make major decisions like raising and lowering interest rates in America. So let's first talk about the Federal Reserve, or the FOMC, the committee that basically decides on whether interest rates are raised and lowered based on the state of our economy. The Federal Reserve was actually established in 1913 to regulate banks. So in 1914, they broke the country down into 12 districts to have a representative in each district to come together and vote on policies. Well, a lot of people say that, in over 100 years, this map hasn't changed, but our population has. And if you look at the map of the U.S., how it breaks down the 12 districts, it's almost identical to the map created in 1914. The bottom line is that we know that one of the main tools that the Federal Reserve has to stimulate and slow down the economy is the tool of interest rate. And this Fed rate is really called the overnight trading rate. And that's the rate that banks can borrow and lend money. And then they mark that rate up to consumers with consumer loans, which is one of the reasons why we're feeling the crunch with higher interest rates today. Now, many economists and analysts will say that the primary reason we're in the financial crisis that we're in today, besides excessive spending from our federal and local governments, is the fact that the Fed dropped the overnight trading rate to 0 or almost 0%, where banks could borrow money basically at 0 interest rate to lend money to consumers to stimulate the economy. The problem is that it works when we're in a recession. But the issue is that when we come out of recessions, it's the Fed's responsibility to vote to raise those interest rates to slow down the borrowing or the creation of debt. And we know that when debt is cheap, prices are allowed to skyrocket because everybody in America is buying payments today. Now, in the housing market, mortgage rates are not directly correlated to the Fed overnight trading rate. But through the history of time, when the Fed rate goes up, so does the 10-year Treasury, which does affect mortgage rates. So when we see the 10-year Treasury rise, then we see mortgage rates rise. And I think if the Fed would have raised interest rates prior to when they started, we wouldn't be looking at the home prices or inflation rates that we see today. All right, moving right along. This next commenter says, I'm 35 years old. Speaking out for my generation, I'm so tired of the narrative of the older generations being a group of hardworking individuals while we are a group of lazy, entitled individuals. Get over yourself. I am a doctor. I contribute just as the generations before me, same as many of my cohort. We have been destroyed at every level of our development, and we continue to take the brunt while the generation before us had so many benefits of theirs. We did not have cheap education, cheap housing, cheap vehicles, cheap cost of living. We do not own nearly as much wealth as a generation before us, and we will never own as much unless wealth is passed down. We have to take on debt just to afford degrees to put us into jobs that will most likely never pay off the debt taken during education due to the high interest rates and high principles from our education. Now we want a home to raise our children, and we can't even afford that. I'm sure a baby boomer will comment on this and say, look, another complaining millennial. Maybe look in the mirror or put yourself in our shoes and you will see otherwise. I won't hold my breath on this one though. All right, everyone. So I can intelligently report on this comment. I want to turn our attention to the U.S. Census report from 2021. When we look at age in America, 36.9% of the U.S. population was from the age of 20 to 44 years old. So only 21% of the population was over 55 years old. And according to a report in 2022, over 42% of the U.S. population are considered millennials and Generation Zs. And let me say that you're exactly right about it being harder to get ahead in today's times. Let me also say that I support our youth and our younger generation. But you all need to stand up and vote for a change. Now, I'm not blaming the youth for all the lack of motivation and drive to make a change in the country, but I would advise you all to pay attention to what's going on in America. Customer service across every single industry has declined. Everyone's faces are buried in their phones, from the hostess at a local restaurant, the employee in the department store, the medical assistant at the doctor's office, and just about everywhere else that we try and spend our hard-earned dollar. Not to mention those driving down the road. The distractions are really more about what we're missing out on and entitlements instead of what we could actually be doing by setting goals to achieve in our lives through loving and serving people. So there's an old saying that goes like this: you can have whatever you want in life if you work as to help others get what they want. And unfortunately, in America, we've now come to accept poor customer service and disappointment from people. Now, doctor, what will you do for yourself and your cohorts concerning your situation? Thanks so much for watching this week's Q&A. If you liked the video, you can smash that thumbs up and let me know that you did. And if you haven't already subscribed to our channel, take a minute and do so now. Hit the alert bell. You'll know every time we upload content just like this. And guys, drop your comments below. You never know, you might just be on next week's Q&A. See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.